How's it going, everyone? My name is Derek Afasi. I'm the owner of Afasi Financial Group. And today's topic, I want to discuss with you federal government retirement. Typically, someone should be watching this video if they currently work for a federal agency and they want to know a little bit more about their retirement plans. Essentially, right when they're trying to get kind of towards the later end of their retirement years, right before they want to start taking distributions. That's why I believe this is going to be most helpful. Now, with the federal government, whenever you have a person that's obviously working for the government, they're going to be offered a couple of different benefits. Hence, why a main reason why somebody wants to work for the federal government. Typically, this individual works for X amount of years, and they'll receive some sort of pension type income at that later date after, let's say, 30 years of service, whatever that is. They'll receive some sort of pension income that will come to them. They will also receive Social Security income that they've accumulated throughout their working years. So those would be the first income stream, the second income stream, and then they have a type of retirement account known as a TSP, also known as a thrift savings account. Okay? Now, a thrift savings account, this is what I really want to talk about, or a thrift savings plan, is what I really want to talk about. It's basically just like a 401k account. Don't try to overcomplicate what a TSP is. It's just like a 401k account, except for a 401k is offered through private institutions. A 403b would be offered through state institutions. A 457 plan might be municipalities. A TSP account is offered to federal government employees, a federal government retirement. So let's say if you're working as, for the IRS, or if you're working as a postal worker, whatever that is, you're most likely going to be offered a TSP account. The way that this bucket grows is your contributions into the TSP and the match from the government will all add money into this, essentially this big retirement bucket. Now, when you put contributions into it and the company's matching you, what determines how large or small this bucket is at the end of the day, at the end of the year? And that has to do with rates of return. Okay? And these rates of return are typically tied to some sort of mutual funds. So you might see different things. You might see the S fund, you might see the G fund, different things that are set up with your TSP account. So what it's essentially saying is, okay, the amount of money that you place in there, the money that the matches that your employer matches, if you have a gain that year on your mutual funds, then this bucket's going to be larger. But it doesn't really matter if you throw in $1 million and let's say you've accumulated $1 million into this bucket and your mutual fund decides to tank right before you're going to retire. Well, then your bucket's going to go from $1 million down to whatever, $100,000. It basically has a limitless potential of failure, just like it doesn't have a ceiling on the growth potential as well. So when reviewing your TSP account, understand that during your accumulation phase, you were placing it in there, you basically chose the different funds, and now you essentially have this bucket that's sitting there at the end of the day. Now, if you're going into your 50s, your 60s, and you kind of understand more that date that you're going to retire, there are certain ways, especially once you hit over the age of 59 and a half, there are certain ways that you could actually take this bucket and you leverage it into an IRA contract. It's known as a transfer, known as a rollover into an IRA contract. The reason why this is important is because you are reducing the negatives with the TSP accounts. And what I mean by that is that there's specific types of IRA contracts. There are IRA contracts set up with insurance companies that allow you to have specific contractual guarantees on that account. So with the TSP account, that individual that's accumulating their money into it, the negatives that could basically affect these accounts and reduce that account further and further down to zero are something known as reverse dollar cost averaging. And what that means is you're going to have to pay some sort of mutual fund related fees when you're going through those TSP accounts. You're going to have some different TSP related fees, or you might use a financial advisor to try to help you choose that. You're going to have an advisor fee with those specific types of accounts, whatever recommendations they give you. Typically, the advisor fee is going to be a little bit more than 1%, but let's just say it's 1%. Mutual fund related fees are about 1%. So right before your funds actually perform anything, you're 2% in the hole. You have to at least make up that 2%. If we're utilizing that hypothetical scenario, you have to at least make up that 2% before you even get to 0%, before you even break even. So the third negative would be downward market loss. In 2008, portfolios took a really, really big hit. It was about 57% on average of a hit to their TSP accounts, to their retirement accounts. So if you had an individual that had $1 million in that thrift savings plan, and let's say they just lost 50%, which is, it's very realistic. I mean, there could be, there's no floor. There's no floor regarding these accounts on the downward market loss. So if that individual lost the 50% that one year, and then it wasn't only, that panic of, okay, I just lost my account, but then on top of it, the company's going to hit you with the mutual fund related fee, and they're also going to hit you with an advisor fee if an advisor was monitoring that account. So if you thought there was a loss of 50%, there's really a loss of 52%. Just like if you say this loss is something a little bit more realistic, 10%. Well, it's not really a 10% loss, it's a loss of 12%. So these are some different things that you could go and set up an IRA contract that specifically stops that bleeding. It would go into a type of bucket. All the money that was already accumulated when you do the rollover, now think of it like a bucket with a lid over it. So let's just say that you went and did the transfer, and before any market losses or anything happened, you took that $1 million, you rolled it over into an IRA contract through it's a specific type of IRA contract through an insurance company. And what this does is they have something known as an indexing strategies. So it's an indexing process that gives you a floor of 0% and all their types of accounts, and then it might give you a cap up to a certain limit. So if you have a specific index that it's linked to, let's say it's linked to the S&P 500, and let's say you have a 10% cap, and the market gains, 10% the first year, then gains 12% the second year, then loses 20%, then loses 57%, then gains 5%. What exactly happens to your specific account? Well, think about it. Kind of think about this bucket, and now we're putting a lid over it. So after the first year, it gained 10%. We understand that 10% is underneath the cap. It was right at the cap of 10%. So 10% they would essentially open up your lid, pour the gain inside, and now your account's going to be sitting at 1.1 million. The next year, it gained 12%, but your cap is 10%, so you're only going to be allowed to have 10% into your account, which is another $110,000. And now that is ratcheted in. It goes by an annual basis. That's where the gains are credited in there. The next year, the third year, you would have had a loss of 20% with anything in your TSP account. With this, because we had that preservation, we have that floor of 0%, it dropped 20%, so you would have had a gain of 0%. The lid remains closed. Nothing came out. The next year, it lost 57%, like in 2008. Well, once again, we have that floor of 0%. So therefore, they're not pulling anything out of your account. It's preserved, protected, and you now have a gain of 0% that year. The next year, because it's going by a one-year basis, if the account gained 5%, well, 5% is underneath your 10% cap, so then you have a gain of 5% into that account. So it's always going to be stepping up and ratcheting and locking in those gains. So it's such a powerful way to get that safe, consistent growth onto that specific TSP money, what's designated for that TSP money. Now, that's one area, that's one way on how you could just basically set it up into an account. You could either do it on a short-term basis, like a 6-year contract. You could do it on a longer-term basis, a 10-year contract. Obviously, the longer that you're able to place your money into those types of contracts, the higher the guarantee that the insurance company could provide in your specific IRA contract. So, but majority of the times, individuals like to leverage these types of IRAs for an additional income source. Now, I talked about the federal employee, the federal government retirement, where most likely that employee is going to be receiving a pension plan when they're in their 60s. They're going to be receiving Social Security when they're in their 60s. And then you had this TSP account that most likely this individual wants to leverage a portion of it or all of it to then use as a third income stream so that they could be living in retirement and getting 3 paychecks, essentially 3 paychecks all at the same time, and live with confidence. If you don't need the money, basically take whatever's extra and throw it into a checking account, whatever that is. But so what you could do is with that same individual that had $1 million, and you could use any variation of that number. This is just a hypothetical number. Let's say that they had an income goal. Maybe the pension was giving them, $50,000 a year, and the Social Security income was giving them another, $30,000 a year, and they want to have exactly $100,000 that they're making in retirement year by year by year. Well, this gives them $80,000, but now we have a gap of $20,000. Well, now they have $1 million because they've already sufficed at age 59 and a half. they could go, and this is one of the things that our company specializes on. We try to show you, we specialize with a lot of the federal government retirement plans and a lot of the TSP planning, and there's a specific process that you have to do. So at any point in time, if this sounds interesting to you, call our 1-800 number, 1-800-566-1002. But essentially what we try to do is show you, when you're calling in, we try to show you the different areas. We try to figure out what your goals are. If we ask you a slew of questions, we determine that, okay, $20,000 is your gap, then you could take a portion of the $1 million. Maybe that's only going to come out to $300,000 that you roll over into a special IRA contract with an income rider attached to it. And what that income rider does is it provides lifetime income that it will grow, that will go to the individual for the rest of their life, for their and their spouse's life. So it kind of acts like a personal pension plan. So while that portion of the monies are going into, 300,000 is going into that contract that's turning on the spigot to make up that net of $20,000, 20,000 plus, then you have the other 700,000 that you could go and place into one of those safe IRA contracts as well. So there's so many different ways to skin that cat. It's not as if you have to take the full 1 million and only throw it into one product, one company, one IRA, etc. There's actually ways that you could transfer portions from one aspect to accomplish one goal while you have another one that's accomplishing another goal. You could do that in several different ways as well. You could go and you could have 4 different IRA contracts with that initial transfer because you suffice that age of 59 and a half. On top of it, let's say if you're working for a federal, for a federal agency, and you decide to leave, and you're in your 30s, you're in your 40s. Well, that also makes you eligible with that TSP account. Now, because you're no longer working there, you could essentially, just like someone would do a 401k rollover, you could do a TSP rollover. That would also make you eligible for that money and place into an IRA contract. Where the rollover does not make sense, or where you cannot do it, the transfer rollover, is if you are under the age of 59 and a half and you're still working for the company. They're not going to allow you to do that in-service rollover. And there's just some little there's just some little tweaks, little specifics that you have to be mindful of if that goal is important to you. We specialize on very safe, consistent planning. We try to show you a bunch of different scenarios. We go through something known as the Retire Sharp planning system. It's proprietary to our company. The name of our website is retiresharp.com. The name of our YouTube channel is Retire Sharp. So we deemed it the Retire Sharp planning system. And what happens is, after asking you a whole slew of questions and really trying to figure out and educating you and saying, you know what, maybe there is a gap there. There are some times that people call us up and what they're doing is completely fine. There's no reason to change anything. And that would be even more perfect, of just basically having that additional additional confidence, saying, okay, what I have been doing for these couple of years has been very correct, and I'm basically on that correct path. But with those individuals that do have that gap, what we do is we show them different financial products, different financial strategies. On average, we go over 1,200 different scenarios per individual that produces the most optimal results. So we might go through the top 3 results and say, okay, recommendation A is good because of this, it's bad because of this. B is good because of this, bad because of this, C, etc. And then we say, but our main recommendation might be A, might be company A, and we basically utilize the strategy with it. And this is the reason why we have a lot of national volume. We are A+ rated on the Better Business Bureau. We've never had complaints. We've always had very good reviews, and it's because of this methodical process, and due in part to this Retire Sharp planning system, because it is proprietary to us. No other financial agency has that, and we try to help educate you any which way, whether it's video tutorials, whether it's literature pieces, whatever it is. We're trying to at least help you guys out. We also offer 24/7 customer service. At any point in time, feel free to give us a call, 1-800-566-1002. I hope you found value in this video. Please make sure to subscribe to our YouTube channel, Retire Sharp, so you have access to the most updated videos. Thanks, guys.